In this video, we are going to talk about investing versus starting a business. So, before starting the video, please like this video. Do subscribe and turn on the notification to our channel for future updates. When launching a business or investing in stocks, there are two significant time factors to consider: the time it takes to make money and the time it takes to run the venture. When it comes to making money from a small business versus stock investing, there is no comparison. Profits from a small firm can take a long time to come in. While short-term stock profits can be made in minutes, long-term stock gains can take 1 to many years, depending on the economic cycle at the time of investment, as discussed further below. How long does it take for a small business to make money? A tiny business can take months, if not years, to show a profit. While business founders are typically judged as failures by themselves and others if their company isn't profitable right away, even the most well-known public corporations have taken years to turn a profit. For almost 4 years, Federal Express, for example, was not profitable. Amazon took 9 years to become profitable. For different reasons, many firms take years to become profitable. However, depending on the model chosen, one can start a small business today and become profitable within a few months. From personal experience, one of our online firms made a considerable profit within a few months because the timing and niche were absolutely right. Nowadays, there are numerous types of internet enterprises from which to pick. Within weeks, a small local service or consultancy business can start earning revenue. While a local consultancy or service-based firm may have a limited market, it can be a great method to test a market or revenue idea. It can also serve as a springboard for online expansion and growth into a larger organization. How long does it take to make money in the stock market? Dividends and capital gains are the two most frequent ways to profit from stocks. As discussed earlier in this piece, dividend income is quite modest in comparison to the capital required to generate it. It can, however, start coming in just a few weeks after you purchase dividend stocks or funds. For most stock investors, the real purpose is to make money. You can buy stocks and discover if you make a profit or a loss in minutes. Most stock investors, on the other hand, do not have this as a goal. The time it takes long-term investors to profit from capital gains in stocks is mostly determined by two things. Let's have a look at them next. Which stocks are worth investing in? First and foremost, your success is contingent on the profitability of the stocks you select. Because most individuals buy index funds like the S&P Wink with tongue sticking out 500 rather than individual equities, this premise is no longer relevant. Cycles of the stock market. In addition to picking lucrative stocks, whether the market is in a bull market, as it generally is, or a bear market has a big impact on investing results, especially for index investors. Many investors are unprepared for the impact of a stock market meltdown on their investment results. Bull and bear markets are influenced by a variety of causes, but they are usually linked to the economy. In a bull market, accumulating wealth is simple and can be done rapidly. Stocks, as represented by the S&P Wink with tongue sticking out 500 index, can, for example, increase in value by nearly 29% in a year, as the index did in 2013. Small business management versus stock investments. How much time do you need? The time it takes to start producing money after starting a business or investing in stocks is essential, but so is the time it takes to manage each effort. Investing in stocks and managing them with a simple asset allocation-based portfolio takes very little time. You can also engage a wealth manager or financial advisor to invest in stocks for you, which would cut down on the time required even further. Learning how to invest in stocks versus managing a stock portfolio takes more time than managing a stock portfolio. Whether you invest yourself or employ a financial advisor, taking the time to understand your assets is critical. What is the difference between owning a business and investing in stocks in terms of profits? As previously stated, there are two primary ways to make money: through income and through capital gains. Let's take a look at the potential for each of them from both the standpoint of starting a business and stock investment. Let's start with the source of revenue. Small business income versus stocks. Profits earned from founding a business or investing in stocks are used to produce income. Stock profits versus small business profits. It's vital to understand that when a publicly traded firm produces money, the income from investors is significantly diluted because there are thousands or millions of stockholders versus simply one or a few small business owners. What is the difference between a business and stock investments in terms of income? The following is a significant advantage of starting a business that you simply do not have with stock investing. Small business profits can range from thousands to millions of dollars. Stock income, on the other hand, pales in comparison to the profits generated by a successful small firm. Because most small firms fail, the crucial word here is successful. However, the reality is that many stock investments lose money as well. Let's look at how much income a typical $1 million stock portfolio could generate. The yield is used to calculate income. Remember, we're comparing cash flow income against capital gains. The S&P Wink with tongue sticking out 500 index represents large publicly traded corporations in the United States. While the yield fluctuates, the S&P Wink with tongue sticking out 500's average historical yield is at 1.8%. $1 million invested in the S&P Wink with tongue sticking out 500 would earn roughly $18,000 per year, or $1,500 per month before taxes. This is the amount of corporate profits that would generally be paid to common stock investors, going back to the origins of stock investing. It's also worth noting that the S&P Wink with tongue sticking out 500 index's historical average PE ratio is around 18. Small online firms, on the other hand, can often be purchased for a PE of around 3, and you get to retain all of the profits. Investing in stocks versus small business profits. Income is received via stock dividends based on the corporation distributing profits in both business and stocks. Profitable corporations, on the other hand, may choose to reinvest profits instead of paying dividends to shareholders. This is fairly prevalent, especially in fast-growing businesses. Small business owners, on the other hand, have the option of either distributing profits or investing them in their company's growth. Small business wealth creation versus stock market wealth creation. The preceding points discussed business income versus stock investing. Income is one of the most important reasons to invest. Wealth creation through gains is the second most important motivation to invest or establish a business. Because your capital, wealth, increases when you sell an asset at a profit, wealth growth is a function of earning capital gains. As a result, wealth building potential is a critical consideration when selecting whether to start a business or invest in stocks. Next, we'll analyze wealth creation versus stock income potential versus small business. Business profits versus stock profits. From a wealth building standpoint, starting a small business offers a significant benefit over investing in stocks. Even a successful little business that was launched only a few years ago might be sold for millions of dollars. With a regular stock investment, this isn't going to happen. Small businesses can also be sold easily and frequently, thanks to the proliferation of web portals that offer enterprises for sale. While stock prices fluctuate often, nothing compares to an individual selling their entire company. It's worth remembering that, as previously said, most small enterprises sell for roughly 3 times annual net income. This could result in a significant profit. Capital gains from stock sales. Of course, stocks can be sold for a profit, which is what most active stock investors want to do. Unlike a small business, publicly traded equities are rarely sold in their whole to benefit stockholders. Rather than hoping that a public firm will be sold, investors seek capital gains by selling stocks or mutual funds for more than they were purchased for. However, my experience has taught me that making a capital gain on a stock is much more likely if you either buy it at the proper moment throughout the stock market cycle, use a successful proactive technique, or hold it long enough to make capital gains when you sell it. The reality is that we have no control over stock market cycles as stock investors, and investing time horizons are not always in our favor. Individual investors can now take advantage of more proactive tactics with multi-decade back testing results. However, most investors choose to invest in equities in a more passive manner. Profitability of a business versus a stock. Aside from the aforementioned obstacles, which asset is more likely to yield a capital gain, investing in a quality stock or starting a small business. Then there's the issue of the company's profitability. Equities have a much better chance of becoming profitable than starting a tiny business and making it profitable, since you can buy stocks that have already been profitable for years. Then there's the capital gain factor. Equities are more likely than small enterprises to be sold for a profit, and here's why: most small firms fail. For most entrepreneurs, this is just a part of the process. You have power over the aspects that define success if you own a business, whether it's a blog or the next Amazon. Your commitment to succeed is a big component in deciding the success of your business. Investing in stocks versus starting a business. The amount of money needed to establish a business versus invest in stocks varies substantially based on the sort of business. Unless you're investing with options, all stock investing is capital intensive. To start a business, you'll need money. For less than $25, you can now create an online business that reaches a global market. This continues to amaze me. We launched an online business for under $2,000, and within 15 months, it was generating multiple five-figure monthly revenue with a very high profit margin. I'm not bragging, I'm just letting you know about the possibilities that exist when you start a business online. Stock investment just cannot compare to the potential possibility presented by a method that does not require any funds. It's also possible to build a website for less than $25 and earn $1,000 to $2,000 per month from ad revenue within a year or two. Other sources of income can help you double or treble your earnings. This is something I see all the time. To invest in stocks, you'll need money. Investing in stocks is capital intensive, which means you'll need all of your money unless you're an experienced investor using options. The capital required to establish an online business is the polar opposite of high capital. Based on the past average yield, $1 million placed in an S&P wink with tongue sticking out 500 based stock index fund will only create roughly $1,500 in income every month. Investors are aiming for capital gains rather than dividends in this situation, as savvy investors would question whether dividend investing is worthwhile if they earn less than $20,000% per year on $1 million of investment capital. So, that's it for today's video. What are your thoughts on our video? Please let us know in comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button and turn on the notification to our channel before you go. Thank you so much for watching.